Ever thought about investing in the stock market but don't know where to start? Well, you're not alone. The world of investing can seem like a maze of numbers, charts, and jargon to the uninitiated. But don't worry, it's not as complicated as it seems. Investing is an essential part of growing wealth. It's like planting a seed and watching it grow into a tree. When done right, it can reward you with a steady income, help you save for retirement, or even turn you into a millionaire. Yes, investing carries risks, but the potential rewards can be immense. This video is your beginner's guide to the world of investing. We'll break down this complex subject into simple, easy-to-understand steps. We'll cover everything from understanding the basics to making your first investment. By the end of this video, you'll have a clear understanding of how to start investing in the stock market. So let's get started, shall we? Before you start investing, it's crucial to understand some basics. Firstly, let's talk about stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, and in turn, you're entitled to a proportion of their profits. Stocks are volatile, meaning their prices can change quickly in a short time, leading to potential high returns or losses. Next up are bonds. Bonds are like loans you give to a company or the government. In return, they agree to give you back your money at a predetermined date along with interest. Bonds typically offer lower returns than stocks, but they're also considered less risky. Then we have exchange-traded funds, or ETFs. These are a type of security that involves a collection of securities, like stocks, that often track an underlying index. ETFs are a great way to diversify your portfolio without having to buy each individual stock or bond. Similarly, mutual funds pool money from many investors to invest in a portfolio of stocks, bonds, or other assets. Unlike ETFs, mutual funds are not traded on an exchange and their value is calculated at the end of the trading day. Now let's discuss the concept of risk and reward. In the investing world, high potential returns often come with high risk. This means that while you could earn substantial returns, you could also face significant losses. That's where the importance of diversification comes in. Diversification is the practice of spreading your investments across different types of assets to reduce risk. It's like the old saying goes, don't put all your eggs in one basket. By diversifying, if one investment performs poorly, others might perform well and offset the loss. So, in a nutshell, stocks and bonds are the bread and butter of investing. ETFs and mutual funds offer a way to diversify easily. And understanding risk and reward helps you make informed decisions about where to put your money. Now that you have a foundational understanding of these concepts, you're ready to start investing. Before you invest a single dollar, define your financial goals. Setting these goals is like drawing a map for your financial journey. It's about knowing where you want to go and charting the best path to get there. Think about what you want to achieve. Is it a short-term goal like saving for a vacation or a down payment on a house? Or is it a long-term goal like retiring comfortably or leaving a legacy for your children? Each goal calls for a different investment strategy. Short-term goals typically require safer, more liquid investments. You don't want to risk losing the money you're planning to use soon. On the other hand, long-term goals allow for more aggressive investments. You have time to ride out market lows and capitalize on the highs. Remember, your financial goals aren't set in stone. They'll likely change as your life does, but having a clear, realistic plan is the cornerstone of successful investing. Remember, your financial goals should guide your investment decisions. Choosing the right brokerage account is a crucial step in your investing journey. It's like finding the perfect pair of shoes. It needs to fit you comfortably, match your style, and serve its purpose. Let's start with fees. Brokerage accounts can come with a variety of charges, from trading fees to account maintenance costs. Some may offer zero commission trades, but make sure to check the fine print for any hidden costs. It's important to find a balance between cost and value. Next, consider customer service. As a new investor, you'll likely have questions or run into issues. It's critical to have a reliable customer service team that can assist you promptly. Look for brokerages that offer support through multiple channels, like phone, email, or live chat. The third factor to consider is the range of available resources. A good brokerage account will offer a wealth of educational materials and research tools to help you make informed investment decisions. Look for resources like stock analysis reports, real-time market data, webinars, articles, and tutorials. Finally, consider the brokerage's reputation and security measures. Ensure your chosen account provider is regulated by financial authorities and has strong security measures in place to protect your investments. Remember, every investor is unique, and what works for one person may not work for another. Take your time to choose a brokerage account that suits your needs and goals. With your financial goals in mind and your brokerage account set up, it's time to create an investment plan. An investment plan is not just a fancy term, it's a critical tool that keeps your financial journey on track. It's a blueprint that outlines your financial goals, risk tolerance, and investment strategies. Like a compass in the wilderness, it helps you navigate the sometimes volatile world of investing. Let's delve into the basics of asset allocation and diversification. Think of asset allocation as your investment pie. This pie is divided into slices, each representing a different type of investment or asset class. These could include stocks, bonds, real estate, or cash equivalents. The size of each slice depends on your financial goals, risk tolerance, and investment horizon. Diversification, on the other hand, is all about not putting all your eggs in one basket. It involves spreading your investments across various asset classes and sectors. This strategy can help mitigate risk and potentially boost your overall returns. Remember, diversification does not guarantee against loss, but it can help cushion the blow if one of your investments takes a downturn. Creating an investment plan might seem daunting at first, but it's a crucial step in your financial journey. It's like having a tailor-made roadmap for your financial future. And remember, your plan isn't set in stone. As your goals and circumstances change, so too should your investment plan. An investment plan is your roadmap to financial success. You're now ready to make your first investment. This is a significant milestone on your journey towards financial freedom. But let's not get ahead of ourselves. Buying stocks isn't like shopping at a supermarket. It requires careful thought, research, and planning. Let's walk through the process. You've chosen a brokerage account and have funds ready to deploy. Now it's time to pick the stocks you want to invest in. Think of it as choosing the ingredients for your investment recipe. You'll want to pick a mix of stocks that align with your investment plan and financial goals. These stocks could be from companies you believe in or sectors you think will grow in the future. But remember, investing isn't about betting on a single company or sector. It's about creating a diversified portfolio that can withstand market volatility. Once you've selected your stocks, it's time to make the purchase. This is done through your brokerage account. You'll enter the amount you wish to invest or the number of shares you want to buy. Then, you'll confirm your purchase. Now you're officially an investor, but the journey doesn't end here. Investing is a long-term game that requires patience and regular attention. You'll need to review your portfolio regularly to ensure it's performing as expected. If your investments are not performing as you'd hoped, don't panic. The stock market has its ups and downs. It's important to stick to your plan and not make rash decisions based on short-term market fluctuations. Sometimes you may need to adjust your portfolio. This could be due to changes in your financial goals, market conditions, or the performance of your investments. It's like fine-tuning a recipe. You're constantly testing, adjusting, and improving to get the best results. Remember, every investment you make is a learning opportunity. You'll make mistakes along the way, but that's part of the process. Use these experiences to become a better investor. Congratulations, you've just taken the first step towards financial independence. Let's wrap up with 10 key tips for new investors. First, grasp the essentials. Understand the market dynamics and the difference between stocks, bonds, and mutual funds. Second, set clear financial goals. Are you saving for retirement, a new home, or your child's education? Third, choose the right brokerage account that aligns with your financial goals and risk tolerance. Fourth, create a solid investment plan. This should include a mix of different types of investments to spread your risk. Fifth, take the plunge and make your first investment. Remember, it doesn't have to be a large amount. Sixth, stay patient. The stock market is a roller coaster, but over time it has historically gone up. Seventh, keep learning. The more you know, the better decisions you'll make. Eighth, diversify your portfolio. Ninth, keep emotions in check. Don't let fear or greed drive your decisions. And finally, 10th, review your investments periodically. Remember, investing is a journey, not a destination. Stay patient, keep learning, and you'll see your financial goals come to fruition.